Good afternoon, everyone, or good morning to those of you joining us from the West, and welcome to our final webinar for 2020. My name's Kate Chalker, for those of you who don't know me, and I work in the Sydney office with Adrian Bailey, who will be presenting today's webinar. Before we get started, I will just do a quick run through of the software for those of you who haven't used Webinar Jam before. So you should be able to see the slides on your screen now, but if you would like to download them, all you have to do is click on the Files button to the right-hand side of the screen, and from there you will be able to download the slides from today's presentation. If you do have a question that you would like to ask at any time throughout the presentation, then you're more than welcome to do so. All you have to do is click on the chat button, again on the right-hand side, and if you type in your question there, that will come through to me and I will be able to interrupt Adrian at some stage and ask that question to him to get you an answer. I will also mention that today's webinar is being recorded and will be uploaded to our website at a later date, so just keep that in mind. So with that out of the way, I will now introduce Adrian Bailey, who is the principal of our Sydney office and my boss. And many of you would be familiar with Adrian. He's been with the firm now for quite a while, and he's well versed in all things tax and asset protection. So Adrian, I'll let you take it away on business asset protection.
Thank you, Kate. Welcome, everybody. I hope that you enjoy the session today. As Kate mentioned, this is our last webinar of the year. We're looking forward to having a little break from webinars and a break over Christmas, of course. This is the 18th that we've done since March webinar. So we restarted them during the COVID break when we couldn't get face-to-face in front of our Legal Resource Club members. And it's something that we will continue on. The feedback has always been quite positive about these sessions, so we'll continue on in the new year and hopefully get back to some face-to-face presentations as well. So today we are going to talk about business asset protection. And in terms of what we're going to have a look at, as usual, we're going to have a look at a case study. So just to give a little bit of meat to the bones, and then we're going to run through some possible solutions. So with those solutions, there will be a couple of different variations, and as always in life, there are always choices. So it's not the case that we suggest that you should do all of these things, it's a question of having a look and at least giving clients options. But the purpose of today is really to run through the sorts of things that we look at when we're looking at a client structure in relation to protecting the business assets, so that you get an idea of what you would consider to be a holistic approach of looking at things with the client. So jumping straight into our case study here, we have our company, which is our trading company, Superpower Co. Proprietary Limited. It runs an electrical engineering business, and we have two shareholders, Jennifer and Sarah. Sarah is the majority shareholder with 70%, and Jennifer has 30% of the shares. They're both directors of the company. The turnover of our business is 2.4 million, and it has a value of 3 million in terms of the value of the business itself. Having a look at the balance sheet, as we always do with our clients, we can notice that we have the main sorts of assets here of the business being $900,000 in plant and equipment, $350,000 in vehicles, and $500,000 in cash or retained profits. Again, looking at the balance sheet, our main liabilities that catch our eye is that there's been a loan from Sarah of $700,000. And that loan was to provide working capital at the commencement of the business and is still outstanding. So our task today, or our review today, is to consider business asset protection. And in doing that, we need to look at the sorts of areas of attack and the areas of risk. And in our presentation today, we'll run through some four main areas that we should be thinking about. So the first one, obviously, would be a claim against the business. So that claim may come because of something relating to the business itself in terms of, as we said, we've got an electrical engineering business, so perhaps some of the work that is done is not up to scratch and we have a claim against the business because of that. But it could also come elsewhere in terms of claims due to creditors or claims in relation to things like leases that the business has and so forth. Our outcome of a claim against the business is really a destruction of value if it's successful, and the value that we'd be wanting to protect in this case, aside from goodwill, would be value of things like plant and equipment, vehicles, and the cash that we have in the business. We've got two directors, Sarah and Jennifer, and as always with directors, we need to think about personal liability of the director. And one of the questions we might ask straight away with the clients is that, do both of them need to be directors, or could only one of them be a director to minimise risk to one? Depends, of course, in terms of the business relationship. Quite often, if it's a family type business, you may have only the one director there. In this sort of scenario where we've got Jennifer holding 30%, it's likely that she's going to want to continue to be a director and take on that risk. So the sort of personal liabilities that we can think of, or we often think about when we're dealing with directors, the main ones are personal liabilities under the Corporations Act. So that can become an issue if there is an issue with superpower and we have to go into liquidation or administration. Then we can have directors personally liable for things like insolvent trading, as well as other things such as preference payments and so forth. Other than that, there is other legislation that does make directors personally liable as well. And generally speaking, that's things like tax. So obviously we have the directors' penalty notices that can be issued to the directors if the company doesn't pay its tax, but also other things such as workers' compensation or work cover. So with that, we would need to, particularly in this type of business being electrical engineering, there's the potential for some sort of injury you would have to think to a worker. So again, we need to bear in mind that there may be some personal liability there of the directors. So that we need to assess then what impact that personal liability would have. And generally that's obviously going to be in terms of the director's personal assets. A dispute amongst shareholders, we need to obviously think about that as well. We have two shareholders here. Anytime you have more than one cook in the kitchen, so to speak, there's always the chance for there to be a dispute. So we need to obviously have a think about that and think about things that we can do to protect against that. If there is a dispute amongst them, quite often obviously that could lead to destruction of the value of the business. And then also we need to think about claims against the shareholders themselves. We've got two individual shareholders here, Sarah and Jennifer. And when we're thinking about that, we're thinking about non-business claims. So we've already been through personal liability of them being directors, but what if there's a claim that's not related to the business, either because of some other form of business activity that they do, or something like a family law claim against either Sarah or Jennifer? So again, we need to consider that if we're looking at our business and looking to protect the assets of the business as well, because a claim against Sarah or Jennifer will necessarily impact on the business, obviously. So running through our four separate areas, what's really at risk if we have a claim against the business? As I mentioned before, plant and equipment would be at risk, the vehicles, the cash that we have. We also have the loan from Sarah of $700,000. In terms of our factual scenario at the moment, that is an unsecured loan. So there may be the risk of an inability for Sarah to recover the value of her loan. And no doubt she is wanting to recover that $700,000 at some stage. Pardon me. If there's a claim against the directors, as I mentioned, we can't escape personal liability for some things, and that can expose personal assets. So aside from reviewing the client's personal affairs and having a look at things like home ownership and other asset ownership, clearly in this case, two of the things that will be impacted are the shares in the company, because the shares in the company represent the value of the business and the assets, and they are held by Sarah and Jennifer. And then also, again, the loan from Sarah. That is an asset of Sarah's, and so it would be at risk if there's a claim against the director due to something relating to the business. Of course, then that leads to subsequent exposure of the business assets as well, if the directors are found personally liable for something relating to the business. For a dispute amongst the shareholders, what's at risk if we have one of those? As I mentioned, the destruction or reduction of the value of the investment. Again, could be an issue for Sarah to recover her loan if there's a dispute amongst the shareholders. and can also lead to personal liability, because quite often what we see in those sorts of scenarios where we have a dispute amongst the shareholders is that some things that should occur do not occur. And a classic example of that is a failure to pay tax debts, which of course can lead back to personal liability for the directors. So again, we need to think about what would happen if there's a dispute amongst Jennifer and Sarah, and things that we can do to try and protect against that. Against the shareholders themselves from non-business activities, so perhaps they're involved in other businesses, perhaps it's a personal matter, or perhaps, as I mentioned, it's family law. So Jennifer and Sarah own the shares in Superpower Co. That is the value of the business, the value of the shares. So if they come under attack for any of these other reasons, then potentially our business is at risk for nothing to do with the business, really. So aside from destruction of value of the investment, we need to think about value or reduction of value of the business itself. And remembering that we have two separate shareholders here, Jennifer and Sarah. So an attack on one could potentially reduce the value of the assets of the other due to that attack. And again, the inability for Sarah to recover the loan, or even worse in some scenarios, what if Sarah goes through a family law dispute and part of the loan is given or ordered to be given to the ex-spouse under the family law issues, and that's called up by them, which would then obviously put the business assets at risk or under stress at least. So those are the sorts of things that we need to think about, and what's really at risk if there's a claim against the shareholders for non-business activities. Some of the strategies that we're going to work through this morning, obviously we're going to look at steps that we can do to protect the business assets. We're going to have a think about Sarah's loan, things that we can do with that. Have a look at some personal asset protection things as well, remembering that an attack because of our business activities may expose our personal assets, and then also consider shareholders agreements to deal with those issues such as disputes amongst the shareholders. So, just to recap, the first section that we're going to go through is claims against the business. And just to recap what would be at risk. That would be the plant and equipment, as I mentioned, the vehicles, the retained profits and cash, and also the ability for Sarah to recover her $700,000 loan. So what are some of the strategies, or what are some of the steps that we could look at in order to protect the value of those assets? For the first one to consider plant and equipment and the vehicles is quite common, obviously, in terms of planning, to have a look at moving them to a separate plant and equipment company. So say, for example, we establish another company, the ownership of which replicates what we have in relation to Superpower Co. We transfer our plant and equipment and our vehicles out of Superpower Co into our new company, and we lease it back to Superpower Co and take a security interest under the Personal Property Securities Act. The rationale behind that sort of strategy, obviously, is that if there's going to be a claim relating to the business, it's going to be against the trading entity. So it's going to be against Superpower Co. If we rely on our plant and equipment for the business and our vehicles, which most often we do, then the idea being that if there's a claim against trading entity, our assets, being plant and equipment and vehicles that we rely on to generate income, are held in a separate entity, and they're not at risk. So with that, that's often one of the first steps you could have a look at to start looking at protecting that value. Of course, in doing that, you often need to think about things like finance. If the vehicles are financed, for example, or the plant and equipment are financed, obviously there's costs in terms of moving it, but the benefit in terms of removing that from risk of the business is obviously fairly dramatic. With that, in your very worst case scenario, if there's a claim against Superpower Co and it has to go into administration or liquidation, clearly if we've moved the plant and equipment out to another company, we could start up again using another company and using that plant and equipment under lease again. So bit of safeguard there if something terrible happens in relation to Superpower Co. One thing to remember if we're using these sorts of structures, and it's more in relation to the new small business entity rules, there are or can be some issues if we're looking at new acquisitions of plant and equipment that we're looking to use the new instant asset write-off or the full expensing, there is an exclusion there if it's long-term hire of plant and equipment. You don't actually get access to those rules. Of course, there's workarounds for that, but just be aware that that's something that we need to consider if we're using this sort of strategy for clients. The other thing that we had in the business that we'd be looking to protect would be the retained earnings or cash. So we have $500,000 in cash in Superpower Co. Quite often, and through the remainder of this presentation, we're going to be talking about the use of debt to protect assets. However, when we're talking about retained earnings, clearly the use of debt won't deal with the franking credits. So we're wanting to make sure that we also retain access to the franking credits. So with that, there's two broad options that we could do. We could use the existing shares to declare a dividend, and obviously our franking credits will flow with that. Or we could potentially use a new class of shares. And we'll go through both options in relation to that to see the different variations there. Obviously, if all we do is declare a dividend of the retained profits, and say, for example, if that's equal to the $500,000 in cash, currently that dividend will go to Jennifer and Sarah. They will each get their respective share, being 70% and 30%. And they will pay tax on any top-up tax on that $500,000 dividend between them. So we may look at changing the existing shares. And one of the things that we could do is we could consider interposing a holding company using a CGT rollover, so 122A or Division 615, depending on the circumstances. And we would, in effect, slot in a holding company in between Superpower Co. And Sarah and Jennifer. So that way, if we're declaring a dividend of our retained profits, being the $500,000 from Superpower Co., that dividend will go to the holding company. If we don't take it out of the holding company, as in we don't, Jennifer and Sarah don't want to get their hands on it, then that's the end of the matter from a tax perspective. It's an intercompany dividend, no further tax to be paid. Other than interposing a holding company, because there are some negatives to that approach, which I'll go through shortly. The other thing that we could look at is actually selling the shares from Jennifer and Sarah. And obviously, if we sell the shares, then there's the potential for a capital gains tax event to occur. And so we want to have a look at eligibility for the discount capital gain under Division 115 and the small business CGT concessions under Division 152, which can allow us to deal with that capital gain, but it's also something that could be considered rather than interposing a holding company. And if we have a look at the diagram, this is on the basis that we've interposed that holding company there by using a rollover. So one of the requirements of that rollover is that Sarah and Jennifer hold the shares in our holding company. So originally they held the shares in Superpower Co. They exchanged those shares for shares in Superpower Holdco, and Superpower Holdco takes up all of the shares in Superpower Co. The negative of that, which I mentioned that there is a negative to this approach, is we still have Sarah and Jennifer down at the bottom there holding the shares. So in essence, we haven't really changed anything from an asset protection perspective in terms of their personal assets being the shares in Superpower Holdco, which then obviously owns Superpower Co. And we haven't increased any tax flexibility there. And that's where we would see the alternative being a sale of the shares to Holdco and using small business concessions and discount gain as a potential alternative to that. And in that situation, you would then recommend that rather than Sarah and Jennifer hold the shares in Superpower Holdco, that it's held by discretionary trusts that are protecting their interests. Also in this diagram, you'll see we've just, for way of an example, we've got the idea that we will also incorporate Superpower Plant Co. The idea would be then we would transfer the plants and equipment and the vehicles over to Superpower Plant Co. and lease it back to Superpower Co. As I mentioned, the idea being that if something bad happens in Superpower Co., we can lease our plant and equipment to another entity and continue on our operations via that. In this sort of scenario, looking at our diagram, Superpower Co. would obviously still hold the business. That's our risk entity. That's where a claim would come against. Plant and equipment held elsewhere, so we've ticked that box. We've separated that asset from risk, and we would have our retained profits sitting down in Holdco rather than in Superpower Co. We could also move the cash down, obviously, and if we wanted to use that cash for working capital in Superpower Co. or to buy more plant in Plant Proprietary Limited, plant and equipment, we could lend that back from Superpower Holdco, and again, the idea would be to take security. So what we're trying to do is have our trading entity as assetless as possible, and where possible, take security over assets that we're using in the business, so that we can secure those interests if there are any issues in relation to the business. As an alternative to that type of structure with our holding company or a sale of the shares, we could consider the issue of what we call discretionary dividend shares, or others call them dividend access shares, to a reserve company. And this will purely deal with our retained profits or our cash, and moving it to an entity that is completely separate from the business. Now, some time ago, we had the issue of Taxpayer Alert 2012-4 by the ATO, where they outlined some of the concerns that they had in relation to the issue of dividend access shares in companies. There was an audit program that came off the back of that. We certainly had acted for some clients that were audited who had dividend shares. In essence, what I explain to clients when I'm talking to them about this Taxpayer Alert and the use of discretionary dividend shares is really what the tax office were looking for were situations where we had a declaration of a dividend from a retained profit rich company, and somehow the individuals at the end of the day got their hands on the money tax free. In situations where clients were audited for their use of discretionary dividend shares post that Taxpayer Alert, in this sort of example that we'll run through, where we're declaring a dividend to a company and lending it back, the tax office didn't have any issues with those clients. So we need to be aware of the tax office interests, and obviously we need to talk to clients about it. But if they're properly implemented and we address the relevant areas of the law, then they're still appropriate to use, and we still discuss them with clients as an alternative. So our form of a discretionary dividend share is that it is a form of a dividend access share, which has a purely discretionary right to income, has no or limited voting rights. There are two options there, depending on what the client wants to do in terms of voting rights there. No rights to capital, and shares automatically lose their rights to a dividend after 47 months. All of those rights are specifically drafted to deal with all of these issues. So the things that we would need to consider when implementing these sorts of shares is value shifting, our tax rate differentiation, so the difference between our small business entity tax rate and our normal company tax rate, the debt equity rules, dividend stripping, dividend streaming, franking credit trading rules, and Part 4A, the anti-avoidance provisions generally. So we do consider all of those things when we're issuing these shares, and we do provide advice to clients on all of these things. I'm not going to run through them in the webinar today in any detail, but clearly there's a bit more to it than just simply issuing a share, which has a right to a dividend. We need to put a fair bit more work into the terms of our shares. Result in this scenario, the result of our dividend would be our retained earnings would be held in a separate company, which we would structure appropriately. To the extent it's not cash flowed or required for working capital, we could lend it back to Superpower Co. With security, and our franking credits are now with the reserve entity. So in terms of a diagram, what it would look like would be we would have Superpower Co. Declare a dividend to a reserve co, and then lent back with interest, with a security interest. Now in this diagram here, clearly we have two shareholders in Jennifer and Sarah. So this diagram is on the basis that we're sending our dividend to two separate companies with a trust holding shares for Jennifer and Sarah respectively. We don't have on our diagram the two separate companies just for simplicity, but obviously in this sort of scenario where we've got two shareholders, we would need to consider either having two separate companies, or the alternative would be that we have one company, and again we replicate our share ownership in that. So we would have 70% held by a trust for Sarah and 30% for a trust held for Jennifer.
Adrian, I might just jump in with a couple of questions before you move on, if that's all right.
Sure.
So Mark was just asking, so to recap, can the existing company have a new class of shares introduced to pay out the retained earnings without consequences?
Yes. So we would amend the constitution to bring in a new class of shares, which would be specifically drafted to deal with the issues that we listed on the tax slide, to make sure that we don't have any issues with either a capital gains tax event or value shifting on the issue of those shares.
Okay, and then a question from Stephen. If the trading company has no franking credits, can you insert a holding company and then create a consolidated tax group?
You could certainly do that. Short answer is yes, if you wanted to go down that. Whenever you're consolidating, you need to think of some other things and the effect that it has on what's called the allocable cost amount, which is how you reset the cost base of CGT assets. But in principle, yes, you could do that.
Okay, and then the final one is just a price estimate to introduce a new class of shares for dividends for the average mum and dad company.
The short answer is it depends. So best off giving us a little bit more specifics, and we can have that conversation separately, because we will give the client different options, because not everyone will want, because there's tax risk in any sort of tax work, but not every client will want to go to the tax risk of having discretionary dividend shares after you let them know about the taxpayer alert. So then you look at alternatives to that. So we do give different alternatives to clients in that sort of scenario.
All right, thank you.
Thanks, Kate. The other thing that we had in our business that we wanted to try to protect was goodwill. So we had our business valuation of $3 million. So that clearly exceeds, in this case, retained earnings and the value of our plant and equipment and vehicles. And you can also have this scenario where you have long-term capital assets within the trading entity, which you can't move for whatever reason. So what we would consider in that circumstance would be a gift of capital from the company equal to that excess, so in effect the goodwill value, to another appropriately structured company. The reason that we have to make that gift to the company is for Division 7A purposes. So in terms of the steps, you would revalue the assets, and then the company would make a gift to another one. Again, there's a variety of things that we do need to consider if we're doing this sorts of work, as to whether the gift itself is valid, whether the company can make a gift, the clawback provisions in the Corporations Act, because this will be what you'd consider to be an unreasonable director-related transaction, so we need to consider those. Division 7A I mentioned, and then 44 and 45B of the 36 Act. So again, we've considered all of those, and if we carry out this sort of work, we give written advice in relation to why they apply and why the gift is valid. But in terms of returning to our diagram, and again, in our example with Superpower Co, we would either have a company for Sarah and a company for Jennifer as reserves, or one company of which each of their trusts would hold shares in the same proportion as they do in Superpower Co. But in this diagram, we're just showing the example of one company here with the trust holding the shares, obviously. And Superpower Co would make a gift of that excess. The Reserve Co would receive that. It would then very often lend that amount back to Superpower Co. And the reason that we're lending that amount back is so that then we can then take security over the assets of Superpower Co. What we're doing in that sort of scenario is we're moving value away from Superpower Co and we're putting it in the hands of the Reserve Co, and the Reserve Co is now a secured creditor of Superpower Co. So if the proverbial hits the fan in Superpower Co, it can take steps to get back its value via its security interest. I mentioned before, obviously, this is all subject to clawback provisions in the Corporations Act. So it's definitely not something you could consider if Superpower Co was already in trouble and looking shaky. But it is something that is effective to protect that value. It will depend on client circumstances, of course. Not all businesses have goodwill, and similarly, not all of them have large capital assets. So it is an option, something to consider for some clients. All right, moving on to Sarah's loan. So if you remember, Sarah has lent the business $700,000. If that's unsecured, she takes the same position as any other unsecured creditor. So just because she's a director or a shareholder doesn't mean that she gets any priority to those funds. So one thing that we would want to do is take security over that loan. So definitely we should look at securing that under the Personal Property Securities Act. In doing that, we would need to think about whether it's the appropriate that the loan continues to be from Sarah. Remembering that she's a director, potentially she may have personal exposure elsewhere, whether that's family law or whether that's other business interests. So it may not be appropriate that she continues to be the lender of that amount. And in that situation, we could potentially look at assigning the loan to a trust first before we take that security. Obviously, we would need to legally document that to make sure that the assignment is valid. And we would also need to think about things like commercial debt forgiveness, because the assignment can be a forgiveness for the commercial debt forgiveness rules. But it may be an option, so something we need to consider in relation to Sarah. If it can't be done, as in we can't assign it without there being issues, then we should still definitely look at taking security over the loan and then having a look at how we can protect Sarah personally, because that will continue obviously to be an asset of hers. Returning to, just to refresh everyone's memory, if we're thinking about what's at risk for directors, if they get sued, as I said, we can't escape personal liability for some things, whether that's a tax office debt or whether that's something like a work cover claim. If that occurs, then that exposes our personal assets because we're a director of the company. So again, to recap, definitely they are going to include our shares in Superpowerco, and for Sarah, the loan that she's got to the business. So with that, we would also need to consider other assets that the clients hold. So perhaps they own a family home, perhaps they hold a holiday home, ASX shares. We really do need to think outside just the straight business box and have a look at what else is owned by the clients to see what things that we could do to protect them. If you've been to our presentations before, you've very likely seen this solution for personal assets. In essence, what we would do is we would look at Sarah and Jennifer's personal assets. We would establish a new trust, which would be a purely passive trust. And say, for example, the value of Sarah's assets, both the shares in Superpowerco and her loan and her other assets outside of Superpowerco, added up to $5 million. We wouldn't want to move the assets themselves because that will cause tax issues. So we would make a gift of $5 million from Sarah to the trust. A gift of money is not a CGT event and it's not dutiable property. In order to document that gift of money, we would use a bearer note or a two-person check. The trust receives the asset, being the money. It then lends that back to Sarah and takes security in the form of either a mortgage over real property or a security interest over things like shares in Superpowerco, her loan. You could take a security interest over that. The end result of this sort of work is that the trust is now a secured creditor of Sarah, unless the trust agrees to release its security, which it will only ever do if it's what you'd consider to be a friendly transaction or it's going to get its money. The trust will only ever release its security in that circumstance if it gets paid, in essence, the amount that it's owed. So what we're doing is we're making sure that no one could ever sell the assets out from underneath Sarah. And really where we're looking at, or Jennifer, and where we're really looking at your worst case scenario there would be if they went bankrupt due to a personal liability from the business and the trustee in bankruptcy took over their assets. So then in that situation, pending bankruptcy clawback provisions, the trust would be first or second in line to get its value back from the sale of those assets. So as I said before, although we're talking predominantly about business asset protection today, we also need to think about the effect that the business has on the directors in terms of personal liability and other things in terms of their personal assets. We mentioned also dispute amongst shareholders and what would be at risk there. As I said, potentially the destruction of the value of their investment or a reduction in it at least. If there's a dispute there may be an inability for Sarah to recover her loan, and that should read personal liability rather than personal liability. And as I said, the potential for there to be some personal liability for things that are dropped while we're having this dispute. In order to address that, anytime you have more than one person having an ownership interest in a business, clearly we should be considering a shareholders agreement or unit holders agreement or governance agreement, whatever you want to call it. In terms of that, in the absence of a shareholders agreement, then we need to revert to the Constitution of Superpower Co. and the Corporations Act. And they are quite limited in relation to the sorts of things that we can do if there is a dispute amongst the shareholders. So what we want to do is override some of those rules in the Corporations Act and also supplement that by our separate shareholders agreement. In terms of the process that we would tend to do with these sorts of agreements, we would normally have an initial meeting, mostly by video these days, obviously, a briefing in terms of the business and the personalities involved and the general objectives. From that, proceed to draft documents, which we would then review with the clients. After that meeting, you would have potentially a further number of drafts, get other lawyers and advisors involved, such as insurance agents, those sorts of things, and have a look at finalising the agreement. In terms of a time frame, it's really in the lap of the clients as to how quickly these things are done. Obviously, sometimes it can be hard to get all of the clients together to discuss the shareholders agreement. And I can tell you, even once finalised, it can be quite difficult to get them to sign, because quite often, psychologically, the people signing thinking that they're giving something away by signing the shareholders agreement, when generally that's not the case. So that's the process that we tend to use. Because it's a process along those lines, it's one of those rare things that we tend to quote for on a time basis rather than a fixed quote. And so with that, the reason behind that is it's really open-ended as to how many drafts that we're going to take. And obviously, the more people that we have involved, quite often, the more drafts that we have to run through and the more discussions we have about the agreement. Every shareholders agreement or governance agreement should have 4 basic components. It should be trigger events. By that we mean events that will allow us to have an exit from the business or exit somebody from the business. And they will be a mixture of what you call compulsory exits, such as death, or non-compulsory trigger events. And an example of that may be a family law breakdown for one of the owners. It may be the case that we want to trigger that, it may be the case that we don't. The other thing that they should include is how we value the business and value the assets of the business. At the end of the day, no matter what we have in terms of value, I can tell you that whoever's leaving will think they're not getting paid enough, and whoever's staying behind will think they're paying too much. So we need to have a fairly rock-solid valuation mechanism there to avoid any sort of dispute over that. Payment terms when somebody exits. So we want to have that set out so that there's no unnecessarily, on one side, there's no unnecessary burden on cash flow, and on the other side, there's some sort of certainty about payment terms. And then also dispute resolution clauses. So to try and avoid the clients running off to see people like me or Kate, we don't want them to see lawyers if we don't have to. So quite often we will have some dispute, well, every time I should say, we'll have some dispute resolution clauses in there that get them to go and see somebody else first, or require them to, before they start engaging in the legal process. And clearly that works well. Other things that you can have, and as I said, that's the bare basics of the sorts of things that you'd want to have in the agreement. Things like how we make decisions, delegation of those decisions, who can make them, our goals and our responsibilities, financial reporting and information. So we don't just need to cover those 4 key areas. Depending on the client and what they're looking for, we can also cover off on some of these other areas, and quite often do in our shareholders agreements. So aside from that, and making sure that we had a shareholders agreement if there's a dispute a dispute amongst the shareholders, I should say, the other thing which I mentioned at the beginning of the presentation was that we would need to think about claims against shareholders from non-business activities. Again, there's the potential there of risk of destruction of the value of the investment or the value of the business or reduction in it. And again, we've got Sarah's loan to consider. So we won't run through them again, but obviously some of the things that could address that risk would be the use of a shareholders agreement, having a look at that personal asset protection, and again, considering whether we assign Sarah's loan to something else. So the idea being that if there is this sort of claim against Sarah or Jennifer outside of our superpower business, that superpower itself doesn't become at risk or doesn't come under attack because of their ownership in Superpower Co. So we'd have a look at those sorts of strategies again, just to make sure that we've got that squared away. So in summary, as I mentioned at the start, business asset protection, sometimes you can get trapped just thinking, oh, we've got to protect the valuable business assets. But in reality, we need to look at other things as well. So we need to look at things like profits, retained profits or cash in the business. We need to consider what would happen with an attack against director and what is exposed there. We need to think about the potential for there to be a dispute amongst our owners. Not everyone gets into business to have a dispute, obviously, but it does happen. We've been through a few at Cleary Hoy internally. So no doubt in terms of you would have had experience with clients as well if you haven't had it personally, in terms of your own businesses. And then also thinking outside of the box, what about a non-business related attack against the shareholder, in this case, Jennifer and Sarah, because they hold the shares individually? How can that then impact on the business? And should there be things that we do to protect Superpower Co. from something silly that they do outside of the business? So as I mentioned at the start, more of a holistic approach in looking at all of these sorts of things to make sure that we're not just considering, okay, well, we've got this piece of plant here, we should move that out of the business to protect it. We're looking at all of the various areas of attack and making sure that if something happens, then they were able to retain the value for those clients, and we will be left with happy clients at the end of the day. I'm going to throw back to Kate.
I do have a couple of additional questions just in relation to the personal secured debt process. So there was one from James. What was the type of debt you mentioned for the gift to the trust? So if you could just clarify the nature of that debt which will be owed to the trust.
Yep, sure. So the step, and I'll use Sarah as an example. The step would be that Sarah would make a gift of cash to the trust. So that's a gift of capital to the trust. The trust would then lend that amount back to Sarah. So on that loan, we would document it by what you'd consider to be a fairly standard loan agreement. If you're lending money to anybody and asked us to draw a loan agreement, it would look like this loan agreement, except there's a couple of changes. There's no interest charged because there's no need to charge interest, and no repayments unless the trustee calls for the loan back. So that loan coming from the trust back to Sarah of that cash amount, being the check, is the debt that's created. If you would consider a personal balance sheet for Sarah, for example, today she would be worth $5 million. Tomorrow she still owns the same assets, but she has $5 million of assets and $5 million of debt, being the $5 million loan from the trust. So in essence, she is now worthless.
Okay, and then the last question we have from Amir. For the gift and loan back process, does the cash actually have to move? And if not, how is it documented? Yep.
So there's two options. Quite often we're talking in essence about equity that people have in assets. So there's no actual cash sitting there in the bank account. Sometimes there is. We're dealing with things like term deposits or that. So in terms of the two options, the first one would be, it's the more complicated one, and I must admit in my years at Cleary Hoy, only something I've done a few times, is that the client could actually go and get a daylight facility and borrow the money from a bank, then gift the cash into the trust lends it back, and then they repay the bank, the daylight facility. As an alternative to that, because obviously there's going to be cost involved with that, the bank's going to charge you something to put that facility in place. As an alternative to that, we use a bearer note, which is like a two-person check. It's a negotiable instrument to document the flow of the cash. So in our Sarah example, it would say, I, Sarah, promise to pay the bearer of this note $5 million. Sounds fairly simple. Is a piece of paper like other checks and money, but is a legally enforceable negotiable instrument. So that's how we would document the flow of cash in that way. The differences between the two, aside from cost of going to get a daylight facility, the advantage of that would be that we have a definite third-party record of the transaction. So for clients who are a little bit more paranoid, I guess you'd say, they might choose that road. But as I mentioned, I've only done that a few times in my time at Cleary Hall.
Thanks, Adrian. That's actually all the questions we have for now. So there will be a feedback email circulated later today. If you wouldn't mind just taking a couple of minutes to complete that, we would welcome your feedback. Like Adrian mentioned, we will probably be continuing these next year, and we know it's not quite the same as having an in-person presentation, but hopefully we'll be able to change that sometime next year. Actually, one question just come through now from Brett. Can property also be gifted and loaned back also in this way?
Yes. However, I'm assuming what you mean by property. You obviously need to think about tax consequences and what the nature of the property is and whether there's a CGT event or duty event by moving the actual property itself. In that case, if there were, then you look at what's the value of the property. So to use an example, if I had a Ferrari owned in my name, if I move the Ferrari, I'm going to be paying transfer duty to the trust. However, I could gift the value of the Ferrari to the trust, and then the value of it would be protected, even though it stays in my name. So if it's that sort of property you're thinking of, Brett, that's that. If it's things like residential property, again, we'd be looking at moving the value rather than the assets themselves.
Thanks, Adrian. Also, land and buildings.
Yeah.
Is it possible?
It is. So same sort of concept in that you would say that the land and the buildings, the value of it is $1 million, which is when I talk about value, I mean the difference between market value and debt, because that's what's at risk. So rather move the land and the buildings and pay stamp duty or CGT, if CGT applies, we could move the value of the land and the buildings.
Okay, I think we'll close off the webinar now. So if we don't get to speak with you by the end of the year, on behalf of everyone at Cleary Hall, we'd like to thank you for your engagement in this year's webinars. And we wish you all a very happy Christmas and a restful break. And we all look forward to working with you in the new year.
Thanks, Kate. Thanks, everybody. Have a great end of year. Bye.
Bye.